Tonight we are looking at a new topic, budget and budgetary control. I'm hoping the class will be complete. It is not impossible that your 30 marks question will be texted on this topic. Last diet, the topic was not tested at all. No question was texted from budget and budgetary control. Yeah, Mr. Moses, good evening. So we are looking at it that there's likely to be a question on budgeting and budgetary control. Although the number in class is correct, our discussion tonight, we shall be looking at what is budget, what is the purpose of budgeting, why do companies go into budgeting, why is budgeting necessary for companies. Also, we discussed budget preparation and other related issues. So what is budget really? If you are required to define budgets, budgets can be defined as plan expressed in monetary terms, covering all the activities of the business entity for a specific period of time. Let us define that again. A budget is a plan that is stated in financial terms, monetary terms, to cover all the activities of the business entity. And it must be for a specific period of time. Usually, a company's budget is for 1 year, 12-month period. Why budgeting? Why do companies need to express their plan in financial terms? Because they are trying to achieve a particular goal. Your plan is to achieve, excuse me, please. Assuming a company's plan is that you want to achieve a profit of 100 million every month. Our plan is that at the end of every month, I should be able to report a profit of 100 million. You now ask yourself, what is the revenue to be generated? What is the cost to be generated? That means you are going to now define your budgeted revenue. How many quantity of the company's products do we need to sell if you are to achieve this budgeted revenue? That is the budgeted sales in units. So you are going to ask yourself, do we need to sell 100,000 units or 1 billion units to achieve a revenue of 1 billion naira? So you have a revenue target. You now put all your plans. You now introduce monetary terms. The selling price in monetary terms, the cost price in monetary terms, the overhead cost in monetary terms. All this will be stated, expressing the company's plan in monetary terms. That is budget. Now, why budgeting? Budgeting, that is the purpose of budgeting now. Budgeting is a means of translating companies' long-term objective into achievable short-term plans. Budget is a means of translating companies' long-term objective into achievable short-term plans. Budgeting can be used to coordinate the actions of the different departments within the organization so that everybody works towards the same goals. So budgets can be used as a means of coordinating activities of the different departments within the organization. You can use budgets to communicate company's plan to individual managers and other employees. Once you draw your budget will show the activities of the different departments and what the company plans to achieve. So we can use budget as a means of communicating company's plan to individual managers and other employees. You can also use budget to motivate managers and employees because the budget will tell us what the company plans to achieve within a specified period. Individual managers and employees are motivated to work towards what the company wants to achieve. In other words, we can use budget as a performance measure. You can use budget to measure the performance of individual managers and employees. Budget is used to identify areas of responsibilities for the implementation of the plan. That budget shows individual responsibility. We are supposed to monitor this responsibility and what is expected of individual employees. Finally, you can use budget as a cost control measure. Because there is budget, then you know the amount to spend on raw materials. You know the amount to spend on labor costs. You know the amount to spend on overhead costs. Maybe your diesel, your fuel. Management has given you a budget for the period. Amounts to spend on individual items. So budgets can be used to control cost. All right. We have defined budgets. We have explained the purpose of budgeting. Our next discussion. Terms in budgeting. We have the budget manual. A budget manual is budget handbook that guide individuals involved in budget processing. The budget manual is an handbook that provides guidance on budget preparation. It will tell us the key objectives of the budget, the planning procedure, and the timetable. Please note, a budget must have a time frame. The budget manual will tell us the budget approval process. Ordinarily, managers will not ask until the budget is approved. Next, principal budget factor, otherwise known as key budget factor. This is also called a key budget factor. It is the factor in the budget that set limits to the volume and scale of operation. Your principal budget factor is that budget factor that limits the volume and scale of operation. It is that budget factor that can limit the company from making profits. Any factor that acts as a limitation to achieving more profits is referred to as principal budget factor. Normally, for most companies, our principal budget factor is the sales volume, the sales demand. Company can produce as many units as possible. However, your volume of production is limited by your sales demand. For example, if you look at this class, currently I have 7 students online. That means the number of students that has enrolled for this class is just like 20 students. Meanwhile, we have the capacity to accommodate 100 students. Our sales volume is just like average of 20 to 15 students. The more students we have, the more profit we are going to make. Now, the number of students is our principal budget factor in equity professional. This factor is limiting our volume of operation and is limiting our profits. So please note, whatever limits a company's profit is what we refer to as the principal budget factor. For most companies, it is the sales volume. However, there could be other factors. Budget to be discussed. First, we start with functional budgets. Functional budgets, also known as operational budgets. Functional budgets. These are budgets prepared for a particular aspect of the business operation. In manufacturing company, the functional budget should include your sales budget. So when you're talking of manufacturing company, there's going to be functional budgets. One is your sales budget. In most cases, sales budget is the first budget the company will prepare. Your sales budget shows the volume of sales the company wants to achieve at a particular time. The unit of sales the company wants to achieve. The sales budget will show the quantity and the naira value. So you are going to have the budgeted quantity and the budgeted selling price. That will now give us our budgeted sales value. This is the budget that is first prepared. After you have prepared your sales budget, then we now come to production budget. Your production budget shows the quantity of units that the company plans to produce. The number of units that we need to produce in order to meet our sales budget. And to meet management requirements. At this point, I need to show you a sample or a specimen of production budget. Please, if you are in this class, I will encourage you to write down these formats or this pro forma for production budget, raw material budget. If you are in this class, I'm going to advise you, please, let us create a space here. Let me create a space here. Let me create a space. Okay. Should I insert? Okay. So please, it is my advice that please you can document it in your book. Although after the class, we are still going to share the material. We also need to prepare I'm trying to expand this. Okay. Let me also copy this. Let's go to this. We want to show a sample of production budget or a specimen of production budget. Look at it, please. Okay, I need to keep my pad. Right. Your production budget. In units. You have your no, not naira, please. It's not in, it's in units. You start with your plan sales volume XX plus desire closing stock of finished goods. So you are going to pick your sales volume, your budgeted sales volume, plus desire closing stock of finished goods, XX, then minus opening stock of finished goods, XX. You now have plus production rejects if any. Add it. You are now going to have a balance. This is your production budget in units. So if you have to prepare production budget, you are going to pick your budgeted sales volume, add your desired closing stock of finished goods, less opening stock of finished goods, then plus production rejects, if any. At times, some question will give you production reject. At times, some question will not give you production reject. So please note this. This is the specimen of production budget. If you are required to prepare one, then the next is material purchase budget. Material purchase budget is prepared using your production budget figure. Your material purchase budget is prepared both in units and in naira value. Look at the specimen for material purchase budget. You start with your production budget in units. That is the figure you derive here. We bring it here. Multiply by material required per unit. You are going to multiply. That means XX multiplied by X. Your production budget multiplied by material required per unit. That will give you material production requirements. That is raw material required for production. XX. When you are done, add desired closing stock of raw material. Raw material. X. Remember, there is difference between finished goods and raw material. For example, flour is a raw material. Your bread is the finished goods. So you are going to now pick your desired closing stock of raw material, add it. Then less opening stock of raw material. Less this figure. You are going to get a figure. Then add anticipated material wastage. The total will give you raw material purchase budget in units or in kg. This will give you material purchase budget in units or kg. Then you can now multiply by the material price per unit or material price. Then multiply by multiplied by material price. Material price per unit or per kg multiply. That will now give you material purchase budget in Naira value. This is the sample or specimen of material purchase budget. So please, you are going to try to master this sample or this specimen. Please, can this person mute? Oliver. All right. We have explained sales budget, production budget, material purchase budget. Next, you can also have expenditure budget, maybe labor budget and what have you. But that is not very common. So we have explained how to prepare functional budgets. The next explanation. These are type of budgets. You can always come back to this. These are something you can. I want to go to. Okay. That is missing here. Okay, please note, we have financial budget. Under the financial budget, you can have cash budgets, budgeted profits or loss, and your budgeted balance sheet. Under budget preparation, you may be required to prepare functional budgets, or you can be required to prepare, like your, if you are dealing with cash budget, please remember, budget is prepared on cash basis. That is, you are going to determine the cash inflows. Now compare this with the cash outflows. The cash budget will tell us whether you have surplus cash, whether you are likely to have surplus cash, or you are likely to have cash deficit. Your cash budget will tell you whether there will be cash surplus or cash deficit. Where cash surplus is projected, then it is the duty of the company's management to determine how to invest Let me repeat that point. If you prepare your cash budget and your cash budget shows that in May, there will be cash surplus in May, it is the duty of the company's management to determine how to invest the cash surplus on a temporary basis. Alternatively, if your cash budget shows that you are likely to have cash deficits in May, is it the duty of the company's management to determine how to finance the cash deficits? So please note this. We can also talk of budgeted profit and loss. Unlike the cash, your cash budget is prepared based on cash basis. For your budgeted profit or loss, this will be prepared based on Accura concept. Remember Accura basis. Income statement is prepared based on Accura basis, which implies that once the company makes sales, whether we receive cash or not, the sales must be recognized in our book. And once the company incurs cost, whether we have paid for the expenses or not, once cost is incurred, this cost must be recognized in our book. Then lastly, under the financial budget, you can have budgeted statement of financial position. You can have budgeted statement of financial position that shows our budgeted assets and liabilities at a specified future period. So you may be asked to prepare any of these budgets. Now we have budgeting system. You can talk of your budgeting system. These are budgets that are continuously updated throughout the financial year. For example, if you are to do 3-month budgets, if you are talking of rolling budgets, assuming we prepare budget every 3 months, our budget is to cover 3 months, January, February, March. So we are going to prepare the first budget for January, February, March. Now, when we are done with, after the end of January, when we have finished January, we are going to delete January budget. We are now going to add February budget. That is called rolling budget. That means at every point in time, we must have 3-month budgets. We also have zero-based budgeting. It's a principle of zero-based budgeting. That is, that all the items is assumed to be zero. Every item of expenditure is assumed to be at zero level until the budget holder justify the amount to be spent. It is assumed that all expenditure item is zero. Labor cost is zero. Diesel cost is zero. Fuel cost is zero. Maintenance cost is zero. Then the departmental head will now go and justify incur this cost. One major advantage of this method is that it can reduce wastages, expenditure wastage. It can eliminate inefficiency. It challenges manager to think. One limitation is that extra time, management time, it is time consuming. You spend time to draft your budget to justify why you need to spend money. You can talk of incremental budgeting. It's a method of budgeting in which next year budget is prepared by adding certain percentage to the current year budget or current year actual results. If, for example, you spend 100 million last year in your budget, you can just say this year, please add 30% to it. I'm budgeting 130 million this year. That is zero, that is incremental budgeting. This type of budgeting is very easy. It is less time consuming. It removes bottleneck, the administrative bottleneck or managerial bottleneck, but it can give rise to budget slack, inefficiency, budget padding. You can talk of top-down budgeting, simply under top-down. It's a budgeting approach where budget is prepared by the senior management for the organization. And this is communicated to all members of staff. The senior management will prepare the budget and send down the budget to staff to implement. Such budgeting is likely to fail because it is not participatory. You can talk of bottom-up budgeting. This is the opposite of top-down. When we say bottom-up, it simply means that the budget is prepared by the low-level management. This budget is prepared by the junior level management and is communicated to the top management for approval. So you are going to prepare your own budget, meaning that you are going to prepare what you plan to achieve at a particular time. Management is giving you the privilege to draft your own budget. Explain to us the plan of action you want to achieve. Why this budget is good? Because it encourages participation. You are trying to make sure that those that will implement the budget contribute to the budget. They feel that this budget is prepared by us. So they work towards achieving the objective. But such budgets can create room for laziness. It can deliberately understate performance. The employees can deliberately understate their own performance. Then we also have fixed budget, flexible budget. Your fixed budget. This is the original plan of the company. It is the financial budget for 1 year. It is the budget that is originally planned by the company. This budget is not designed to change. A fixed budget does not accommodate changes in circumstances. So please note, your fixed budget is prepared prior to the budget year. For example, the 2026 budget. This will be prepared maybe 2025, October, November. The budget for 2026, most companies will prepare their budget during October, November. The fixed budget is prepared year. And this budget is fixed. It's not designed to change. However, because of uncertainty in budget, remember, budget is prepared based on estimates and forecasts. Your budget is prepared based on estimates and forecasts. This estimate and forecast is not 100% reliable. That means there is uncertainty in budgets. If you prepare budget for 2026, that is fine. But you must bear in mind that that budget is based on estimates. There is the possibility of error in your estimate. There is also the possibility of changes in circumstances. Errors and possibility of changes in circumstances. You can have flexible budgets. Several approaches may be used for evaluating risk and uncertainty in budget. One of them is to prepare flexible budgets. Your flexible budget is the budget that recognizes changes in circumstances. It can accommodate changes in production volume and sales volume. It also recognizes cost behavior pattern. When we say cost behavior, it will show if the cost is variable cost or fixed cost or mixed cost. Remember variable cost. This can cost that vary with the volume of production. Like our raw material cost. The more we produce, the more raw material cost we are going to incur. So raw material is assumed to be variable cost. But also note, your flexible budget is also prepared prior to the budget period to make provision for changes in circumstances and where there's errors in our budget. All right. The last one that I need to mention is what you call the flex budget. You may be required to flex a budget. Like I said, your fixed budget is prepared prior to the budget year. Flexible budget is prepared prior to the budget year, but your flex budget will be prepared at the end of the financial year, when you have gotten the actual results. You can only talk of flex budget if you have your actual results. Flexing a budget simply means using the actual output against the budgeted revenue and your budgeted cost. Hopefully we get to budget preparation, we'll be able to explain more. All right. Any question, please?
Yes, sir.
That Oliver.
Yes, sir. Good evening, sir.
I didn't see you last week. You can answer
Yeah,
your
that's
question.
true. That's correct. Okay, my question is this. The cash budget has the same attributes with the cash flow. Is that correct, sir?
Is it a question?
Yes, I'm asking. The cash budget, you said the cash budget is prepared in order to ascertain, to determine whether there will be surplus or deficit at a period of time so that the managers can make adequate preparation, either to invest the surplus or to make provisions for the deficit. So it also has the same attribute as the cash flow. Correct. Okay. Now the second one is, yeah. Okay. Now the second one is this flexible budget. All budgets, are they not flexible?
Okay. Is that a question?
Yes, sir.
Okay. All budgets, are they not flexible? First is your fixed budget. There's what we call what the company originally intends to achieve. For example, let us take Nigerian Bottling Company. Assuming you work with Nigerian Bottling Company, and we have a budget session where your MD is seated, and at that budget session, Nigerian Bottling Company at the budget committee session agrees that coming 2026, we want to achieve a safe volume of 12 billion bottles of Coke. At the budget session, the management said, we want to try to work towards achieving a safe volume of 12 billion bottles of Coke in this country. That means every month, we must be able to achieve 1 billion bottle, at least 1 billion bottle of sales. Now, the MD now sign up that budget. That is the original plan of the company. That is your fixed budget. That budget is what we want to achieve as a company. Immediately the MD signs or a senior management signs, it becomes an executive order that every member of the company must work towards. That is what the company will have in their book, what we plan to achieve. That budget will have showed the expected revenue for 12 billion bottles, the expected cost to be incurred to prepare to produce 12 billion bottles, and the expected profit to be achieved. That will be filed up. That budget will not change. So, in summary, some budgets are not designed to change. Management wants everybody to drive towards that goal. However, management is aware that there could be changes in circumstances. Along with the fixed budget, management will now introduce flexible budget. Budgets that can accommodate changes in circumstances. So, in summary, the fixed budget is not designed to change. Management wants to drive all staff to work towards that fixed objective. Because if you allow the budget to be too flexible, They might say, okay, Shebi, we have a choice. If you cannot sell 12 billion, I can go and sell 10 billion. Now it's not a must. So management want to drive this staff towards a specific goal. Is that clear, Oliver?
It is clear, sir.
All right. You can go to your study pack, page 128, 129. I don't know if I should start with question 2 or question 3. I wish to solve the 2 questions, but no, this time I'm not sure of this time accommodating us. Okay, let's start with illustration 3. Eco Limited, page 129 of your study pack. Page 129 of your study pack. Illustration 3. Eco Limited. Please, are we there now? Give me water, please.
Yes, we are there.
Together, sir.
All right, let's look at that illustration. Eco Limited is a small manufacturing company producing 2 highly quality products called products K and Lay. Both products use a raw material T costing 30 naira per kg. In their manufacture. The directors are reviewing the company's stock management policies for the forthcoming year as part of the annual budget preparation. Due to the product specification, quality is an all-important factor. It's an important factor. A quality control inspection takes place immediately after the production cycle has ended. That means quality control will come after we have finished production. At this point, any inferior products are rejected and only good production becomes available for sales. In addition to these losses, a certain quantity of quantity of waste is unavoidable for material T due to the cutting process for both products. The following forecast information has been extracted from the departmental estimates for the year ended 31st December 2020, the budget period. We have products K and products Lay. Says quality approved units. Then finished goods stock to increase by this at the end of the year. Post-production rejection rates 2%. And after production, we expect 2% of products K to be bad and 3% of products Lay to be bad. Material T usage per completed unit net of wastage. That means to produce a unit of material K, a unit of products K, we require 2 kg of material T. That is net of wastage, excluding wastage. Why to produce a unit of product lay, we require 3 kg net of wastage. Material T wastage, 5% for product K and 10% of product lay. Additional information. Usage of raw material T is expected to be at a constant rate over the period. Annual cost of holding 1 unit of raw material in stock is 17% of material cost. Next, the cost of placing order is 30 naira per order. Eco Limited maintain a constant 1,000 kg of safety or buffer stock of material T, regardless of the quantity order each time. Requirements A. Prepare operational budgets for the year ending 31st December 2020 under the following headings, showing your workings clearly. 1. Production budgets for products K and product lay in units. Purchases budget for material T in kg and value. Then calculate the economic order quantity for material T. Everything 15 marks. I think this question is very clear. We are required to prepare production budget. You can refer to the sample of the specimens you are giving. So I will move straight to this. Production budgets in units. (31st December 2020). If you have the specimen Q2, you are going to start with your plan sales. Plan sales in unit. Okay. First, let's take the products. Let me cancel this out. We have the products. We have products K and we have products lay. Next, pick your plan sales in units. If you look at the question, quantity approved units. The sales in units for products K, 23,000 units. For product lay, 10,000 units. Please pick your figure. This is 23,000 units. This is 10,000 units. Now, plus our closing stock of finished goods. Closing stock of finished goods. If you go back to the question, finished goods stock at the end of the year, this will be 275 and this will be 185. Then pick this figure. 275, 185. Then minus opening stock of finished goods. In this question, we are not giving the opening stock. This becomes nil. You can now add up. You can add. This will give you production budget before rejects. No, we have not added rejects.
Yeah.
Production budget. Before rejects. 23,
No,
275.
22. 20. Okay.
Can be 22 now, we are adding.
Yeah.
10,185. This is the production budget before we introduce rejects.
Let's reject.
Before rejection. That's okay. Plus reject now. You now come here. Plus production rejects. You are going to have a figure here. That will now give you your production budget in units after rejects. You know, if you manufacture, you can manufacture some of these products may be bad. That's what we call reject or defects. Now, if you go back to the question, hold on. All right, let's go on with the class, please. If you look at the question, please listen to this aspect. Examiner says, let me take you to the question. Post-production rejection rate. That means after production, we expect 2% of product K to be rejected. That means the good production, if you are going to produce 100%, out of this 100%, 2% will go bad. That means if you say 100% minus 2%, that means it remains 98%. So if you produce 100, you are going to produce 100%, but 2% of it will be rejected. That means your good production that means quality standard is 98%. For product K, we can now use this to derive our figure. Now look at it, please. Please look at this. Look at the working here. This will be 100%. This one is 2%. That means this one you have here, because production budget before reject plus reject must give me 100%. That means this is 98%. This figure you have here is 98%, because 2% is reject. 98 plus 2% will give you 100%. So if you want to work this reject now, please look at the working. Rejection for K is equal to 2/98 multiplied by 23,275. That is how to get the rejection number for product K. For product Lay, we are told that 3% is the rejection, and we are going to produce 100%. That means this figure here is 97%. If you want to get rejection for product Lay, rejection for product Lay, it becomes 3/97 multiplied by 10,185. Please work this out. Please let us apply our calculator and work this out.
For K, it's 475.
475. Oh, 475.
For Lay,
For
315.
Lay,
315.
315. We can return here now. Production reject for K, 475. This is 315. You can now add up. $23,275 plus 475. That will give you total production budget. You are going to produce both the good one and the expected rejects. Please sum up. This should give you
750.
750. This will give you 10,500 units. You are done with your production budget. That means the company will have to produce for product K. The company have to produce 23,750 units. While for product Lay, we have to produce 10,500 units. You are done with your your production budget. Any question, please? If there is no question, we can look at the next purchases, that is material T purchase budget now. Our next is material T purchases budget. Remember, we have two products. Products lay and products K and products lay. So you are going to start with our production budget, the figure you computed up. Here we are going to produce 23,750 units. Here we are going to produce 10,500 units. Now multiply by your material required per unit. Multiply by material required per unit. Let's go to the question. Look at this. Material T usage per completed unit, net of wastage. To produce 1 unit of product K, we require 2 kg of material T. While to produce 1 unit of product L, we require 3 kg of material T. We can now go back now. I'll come here. Here I require 2 kg per unit. Here I require 3 kg per unit. So multiply 23,750 multiplied by 2 kg. That will give you production requirements.
47,500.
How many here?
47,500.
And the other one,
500 kg. It has changed now. To produce products K, I require 47,500 kg of material T. How many do I require here?
31,500 kg.
31,500 kg. You have gotten material required for production. But this is not the material to be purchased. You have gotten material required for production. But this is not the raw material you need to purchase. You now go and add your closing stock of raw material and less opening stock of raw material. For this question, let me refer you to that. Okay. Look at additional information. Examiner says Eco Limited maintain a constant 1,000 kg of safety or buffer stock of material C, regardless of quantity purchased each time. Now, please note, if you are told in a question that the company maintains a constant level of stock, what that means is your closing stock is the same as your opening stock. If you are told in any question that the company maintains a constant level of stock, what it means interpretation is that the closing stock is the same as the opening stock. In this case, we can ignore the figure. Let's go back to our solution. If you look at this, I'm supposed to add the closing stock and less the opening stock. If I come here and I can say, I can do like this, plus closing stock of material. Let me shorten it. I'll put 1,000 kg here. 1,000 kg here. I'll say minus opening stock of material. 1,000 kg minus 1,000 kg minus. At the end of the day, I'm still going to get material purchase before reject. Material purchase before waste. Before wastage. This will give me 47,500 kg. This will give me 31,500 kg. You can decide to ignore these two. You can also decide to show it. Now you have gotten your material purchase before your wastage. Now add anticipated material waste. Now come here. Now come here. Plus anticipated wastage. Now let's go to the question. If you refer to the question, examiner says 5% of material for product K will be wastage. While 10% for material for products lay will be waste. That means for me to purchase, I must incorporate all right, we have a temporary network glitch. You are going to purchase 100% of raw material. For products K, you expect 5% of this material to be wastage. That means what you are going to use for your production is 95%. So you now come here. To calculate the waste. Total material purchase budget, it must be 100%. 100%. Now, if 5% is wastage here, that means this is 5% because everything must give me 100%. If you please, let's continue. So if you want to calculate wastage for product K, it becomes 5/95 multiplied by 47,500 kg. That will give you the wastage for products K. Please compute. Wastage for lay. For lay, it becomes, as I say, 10% will be waste. That means 90% is used for production. 10/90 multiplied by 31,500 kg. Please get wastage for lay and K. What do we have here, please?
2,500.
I think it should be 2,500.
Yes.
Why this should be 3,500 kg?
Yes.
You can now return here. This is 2,500 kg. This is 3,500 kg. Now total purchase, 47,500 plus 2,500. This becomes 50,000 kg. This becomes 35,000 kg. So we are going to purchase 50,000 kg material for products K and 35,000 kg of the material for product lay. And you know it's the same material. Material T, material T. Now please listen to this very well. The same material is used on product lay. Use the same and come here and do like this. You can do like this. Total material C purchase budget for product K. We are going to purchase 50,000 kg. For product lay, we are going to purchase 35,000 kg. That means total is 85,000 kg. What is the price per kg of material K, of material T?
30 naira.
30 naira. You can now get the value. Material T purchase budget. Purchase budget a naira value is equal to 85,000 kg multiplied by 30 naira per kg. Please, what is the naira value?
2,550,000. 550,000. 550,000.
550,000 naira. This is the amount the company will budget to buy raw material. This is the amount the company will budget in order to buy the raw material. You are done with requirement A2. The last requirement here is to calculate economic order quantity. Although this question is not part of material, it's not part of budgeting. So we can decide to leave it, or we can decide to solve it. Q1 is supposed to take you working capital management. So under your working capital management, Q1 will discuss with you inventory management and inventory control. So we can decide to solve this. It's not a major issue. The B says calculates economic order quantity. Just take the formula. The formula is 2D CO over CC. I don't know if you have gotten to working capital management. Where your D is annual demand or usage. In this case, annual demand is 85,000 kg. That is the material we need to purchase. Our annual demand is 85,000 kg. Your CO, That is the ordering cost per order. Look at the additional note. Examiner say this is 30 naira. Our CC. That is the carrying cost per unit per annum. That is your stock holding cost. If you check additional information, examiner say your carrying cost is 17% of material cost. Look at additional information. Examiner say your carrying cost, let me pick, is 17% of material cost. Material cost is 30 naira per unit. Find 17% of this. That should give you 5.1. You can now calculate your EOQ, economic order quantity, is equal to 2 multiplied by 85,000 multiplied by 30 divided by 5.1. Please calculate your economic quantity.
1 million.
That is the quantity that will minimize your cost. What do you have, sir?
Square root 1 million. And that's
just give me the final answer.
1,000.
10,000 kg.
Yes, 10,000. I said 1,000
kg.
I didn't say 10,000.
What do you say?
1,000.
Oh, 1,000. Okay, that's fine. Yes. Yeah, that's 1,000. So at any point in time you want to place order, the company will order 1,000 kg because that will minimize your cost. Let me just remove 10. You are done with the question. We are done with our question. Wow. We have, it is obvious that with a two, check your study pack, page 128. ABC. Let's look at this question together. ABC. Apparently, we can't finish this question in 30 minutes, but we can solve 50% of it. Please confirm you are in that question. Let's go to it. Are we good to go, please? Go. The class is silent. I want to be sure you are in that page.
Yes, we are there. I'm there.
Yes, sir.
ABC is a manufacturing company which makes a product Zeta. The budgeted monthly production and sales are 200,000 units. A standard cost has been estimated on the basis of direct cost of 7 naira of material. Look at it, please. That 7 naira is explained. That 7 naira, that is the material cost per unit. In brackets, you have 2 kg at 3 naira 50 kobo per kg. Explain that. It means to produce a unit, you require 2 kg of raw material. Material price per kg is 3 naira 50 kobo. So if you multiply 2 kg by 3 naira 50 kobo, that will give you 7 naira. That is, the 7 naira is material cost per unit. The 350 is 3 naira 50 kobo is material cost per kg. So please note, you should be able to differentiate between cost per unit and cost per kg. Next, 6 naira for wages. Look at it again. Examiner say in brackets, half an hour at 12 naira per hour. If you are to interpret that, it means that to produce a unit, you require half an hour. That is 30 minutes. And the labor rate per hour is
12 naira. 12 naira per hour.
12 naira per hour. So if you multiply 0.5 hours by 12 naira per labor hour, that will give you 6 naira. That 6 naira is labor cost per unit. Why that 12 naira is labor cost per hour? You should know the difference between cost per unit and cost per hour, per labor hour. All right. In addition, variable overhead has been determined at 2 naira per unit. Monthly fixed overhead is 200,000 naira. Monthly sales for the first 5 months of 2015 has been estimated as follows. Look at it. The budgeted sales for January 2015 is 210, for February 180, for March 210, for April 220, and for May 200. Actual sales at the end of 2014 were 190 in November and 220 in December. Okay. Next paragraph. Cash received from the sale is based on previous experience. Please change it. It should be previous, not provided experience. Cash received on sales is based on previous experience and is expected to be 60% in the month of sales, 25% following month, 10% 2 months after sales. Expected that 5% will be irrecoverable and will be written off in the month of sales as bad debt. The selling price is 18 naira per unit. Creditors for raw material are paid at the end of the in which they are incurred. Wages are paid the same month as incurred. It's not impossible. This is missing your question. Wages are paid the same month as incurred. Up here. Sorry. Disappear. another place. Let's continue. Look at that two paragraphs. It's talking and payment. All right. Wages are paid the same month. As incurred. Variable overhead. Let's take this away. Are paid 60% in the month in which they are incurred and 40% the following month. Fixed overhead includes 25,000 naira of depreciation and are paid 1 month after the costs are incurred. At 1st January 2015, costs for bill and fixed overhead are estimated at 92,000 naira and 150,000 naira respectively. Next, the company intends to have finished goods at the end of each month, equivalent to 15% of the following month budgeted take. For raw material stock, the policy is to have 25% of following month production requirements. Stock at 1st January 2015 are estimated at 22,000 units of finished goods and 104,000 kg of raw material. The cash balance as at 1st January 2015 is estimated to be 13,000. Requirements. Produced for the month of January, February, March 2015. Production budget in units. Material purchase budget. Cash budget. And budgeted profits and loss account for the 3-month period. Without wasting time, let us prepare production budget in units. You know, for once you understand what to do, you don't need to waste your time. I want to prepare production budget for January, February, March 2015 monthly budget. Let's go to this. Come here. We are dealing with ABC. Budget. The months are January, February, and March. This is the budget you are going to submit. However, we need to make provision for a you are going to see why you need to make provision for April. Because of the company policy. The policy says closing stock is 15% following month sales budget. This is April. So we need to make provision for April. So if you want to do your production budget, you start with your planned sales. Planned sales. If you look at the question, for 2015, what is the budgeted sales in January? You have 210. For February, 180. Please look at the question. For March, 210. Look at it here, please. It's 5 months, 2015, has been estimated as January 210, February 180, March 210, April 220. You have picked your planned sales in units. Now plot our desired closing stock. Desired closing. Please need to put of finished goods. Let us check policy on finished closing stock. Look at the last paragraph. The company intends to have finished goods at the end of each month, equivalent to 15% of the following month's budgeted sales. 15% of the month budgeted sales is the closing stock for the month. Let's go to it. For January, then I need to get 15% of the following month. Which month follow January?
February.
February. So I need to calculate 15% of February budgeted sales, planned sales. Compute 15% of 180,000. What do you have?
7,000.
What do you have?
27,000.
It should be 27,000.
Yes.
That is the closing stock for January. If I want to compute for February, 15% of following month budgeted sales. That means after February is March. Compute 15% of 210,000. What do you have?
31,500.
That be
31,500
for February. If I want to get for March, following month after March, April, budgeted sales for April, 220,000. Please compute 15% of 220,000.
33,000.
That will give you 33,000. If you want to get closing stock for April, go and look at May budgeted sales. That is 200,000. Now compute 15% of 200,000.
That's 30,000.
That becomes the closing stock for April. That becomes closing stock for April. This is 30,000. Then less your opening stock. Opening stock of finished goods. Of finished goods. If you look at the question, let's go back to it. Stock as at 1st of January 2015 are estimated as 22,000 units of finished goods. That means as at opening of January, opening stock of finished goods is 22,000 units for January, less minus 22,000 units. If you want to get closing stock for February,
Opening stock for February.
thank you. Your
Closing stock of February
becomes opening stock for February 27,000 less.
31,500.
Closing stock for February becomes opening stock for March 31,500. Closing stock for March, opening stock for April 33,000. In this question, there is no production rejects. You can now production budgeting for the 3 months. There is no production rate. So this will give us our production budget. 210 plus 27 less 22. What do we have?
215.
Let's make it snappy.
215.
215, yeah. 180 plus 31,500 plus minus 27. What do we have?
184.
184.
184,000, yeah.
500. 210 plus 33 minus 31,500. What do we have?
211,500.
211,500. Then the last one, 220
23.
plus 30 minus 33.
223.
Please check it. 220 plus 30.
That's 250.
33,000. That should give you 270.
Sorry, 217 rather. 27. Sorry. 27. Yeah, 217, sir. Yeah.
That should be 270. Yeah. Just 1 minute. Please, just 1 minute. We are done with that. Class, I just have to do a changeover. Sorry, brothers. So you are done with your production budgets. For this kind of question, production budget, material purchase budget, cash budget, there's a defined format you can follow. Understand the format. The highest that could go is that the examiner can introduce production reject. Once your budgeted sales, add your closing stock of finished goods, less your opening stock, then add production rejects, if any. In some questions, there will be reject. Why in some, there's no reject? Then the next question is raw material purchase budget. I have just like 10 minutes. Let me round up. At least I can solve that. Raw material purchase budget. Again, don't forget the formats. I'll come here. Material purchase budgets for 3 months, but we need to make provision for in April. You have the months January, February, March. Then I'm going to make provision for April. You start with your production budget in units. The production budget in units. Here I'm going to produce 215,000 units. Here I will produce 184,500 units. Here I need to produce 211,500 units. Then here I need to produce 217,000 units. This is the unit to be produced each month. Then multiply by material required per unit. Per unit. Oh, I have to take it off. I've entered into that place too much. I've entered into January too much. So I just like this. Let me shorten, multiply by material required per unit. To produce 1 unit, we require 2 kg. 2 kg. 2 kg. 2 kg. So for me to produce 1 unit, I require 2 kg. Multiply by number of units to be produced. I'm going to produce 15,000 units in January. That will now give me production requirements. Production requirements. Requirements. 2 multiplied by 2, 15,000. What do we have, please?
430,000.
Oh, yeah. Forward.
430,000.
430,000. 2 multiplied by 184,500. How many kg?
369,000.
Yeah. I want to by level. This should be
369,000
kg. Multiply here. This should be 423,000 kg. Then multiply here. What do you have? 434,000. That is the material required for production in each month. Then now add plus closing stock of raw material. Closing stock of material. If you go back to the question, the last paragraph, examiner says, look at it. For raw material stock, the policy is to have 25% of the following month's production requirements as your closing stock. Look at it, please. Look at it, please. If I want to compute closing stock for January for raw material, then I'm going to get 25% of following month's production requirements. Compute 25% of 369,000. That becomes closing stock for January. Following month after January, February. Hello, guys. Let's compute.
Yeah. That's 92,250.
What do you have?
92,250. 92,250.
250. If I want to get for February, I will now say following months after February. That's March. 25% of March production requirement, 25% of 423,000. What do you
They
have
have
here?
105.50.
105,
750.
750, right?
Yes, please.
If I want to get for March, then I need to come 25% of April requirements. What do you have here?
So that's 19250. 109,250.
109,250. I don't need to bother for this because I only require 3-month budget. We only brought in April to help us. Then when you are done, get less minus opening stock of material. Look at it. Stock at 1st January 2015 are estimated at 22,000 of finished goods and 104,000 kg of raw material. Opening stock in January is 104,000. If I want to get opening stock for February, then I'm going to look at January closing stock. That is 92,250. If I want to get close March, sorry, opening stock for March, the closing stock for February becomes opening stock for March. 105,750. You don't need to bother about April. Our business is to prepare 3-month budget. We only brought in April to help us. Once you complete your 3-month budget, just get your, you can now get your material purchase in kg. Purchase in kg. 430 plus 92,250 minus 104,000. What is the material purchase? How many?
4,250 kg.
418,250.
How many do we have here? Sum up.
382,500 kg.
8,500 kg. How many we have here?
Four two six 500.
4, 2, 6. Oh, this is negative. Oh.
Positive.
No, it's positive.
Let's close in stock now.
Yeah.
Okay.
Yeah.
The answer is what?
426,500.
500, yeah.
Okay, 426,500. You have gotten material purchase in kg. That means in the month of January, the company will purchase 418,250 kg. Of February, the company will purchase 382,500 kg. In the month of 426,500. They now introduce the price. What is the price of material per kg?
We are
This
told
is
this
3 naira 50
kobo.
kobo. 50 kobo. 3 naira 50 kobo. Get the value. 3.5 multiplied by 418,250. What is the material cost to be incurred in January?
For March. For March is 1,492,000.
Please go ahead.
For March, 1 million
Just give me 1 for what? 1 for
to 750.
that.
For January, 1,463.
March first. You said March.
Yes, I'm giving you that of March. I'm talking of January now.
Okay, I didn't get that. Okay, give me January, no problem.
Okay, 1,463.
146.
875.
1
143,875.
Something is missing here. Your line is actually breaking, so at times I didn't get it.
Okay, sorry.
1463875.
146.
875.
1463875. 875. That would be the money to be spent on material in January. In February, we are going to spend
1338750.
1338750. Then in March, we are going to spend
1492750.
okay, 1492750. Okay. Although the line went off temporarily, but this is where we are going to stop. We have prepared the first two budgets, material purchase and material and production budget. This is what we can do within the time stipulated.